Hey there, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, April 30th. You're, of course, tuned into On Trend, the show designed to keep you on the right side of the trend. So today we're going to look at the sector leaders as far as new highs are concerned. We'll show the yield curve turning up as well as banks. Bond ETFs are testing their breakout zone. We'll look at precious metals and copper. And finally, we'll finish with some stocks to watch. So we're going to start off with the high-low percent indicators for the sectors. And the reason I like to look at these indicators is twofold, two reasons. First of all, I can get an idea of where the leadership is in the market. Stocks making new highs are leading the market. Second of all, I can focus on the big six sectors, which account for 79% of the S&P 500. These six sectors here that we're going to look at: technology, healthcare, finance, communication services, consumer discretionary, and industrials. And I want to see at least three of the six having significant number of new highs to help support at least a 50 plus 1% argument that we're in a bull market. And we're seeing that because we got leadership coming from technology, finance, and industrials. So just to give an idea of how the sector holdings break down, I went to the State Street SPDR website. It is spdrs.com. And then I clicked on the holdings tab there. There you can see the individual stock holdings. And below you can see the sector holdings. And right away you can see that information technology is the biggest, followed by healthcare, financials. So those three sectors alone account for like 47% of the S&P 500. And then you've got communication services, consumer discretionary, and industrials. And these, as far as I'm concerned, are the big six. And these are the six sectors I want to focus on as far as broad market health is concerned. All right, so here we are back on the chart. And first of all, we can see that S&P 500 high-low percent has moved above 10% in February, March, and April. Hasn't gotten much above 10 plus 10%, but it's more bullish than bearish. All right, it's not until we start getting negative and below that minus 10% threshold like we did in October that it becomes a bearish development. And we did that in December as well. Now, as far as the leading sectors are concerned, technology is still at the top. You can see it had a high-low percent reading of 14.7% and a couple of readings getting above 30% and several readings above 20%. So that's where your leadership is right now. But the other two sectors that I'm seeing leadership in are finance and industrials. And that is a positive for the market. Look at finance. We got high-low percent at its highest level since probably the summer, maybe further back. If you look at this chart there, you can see we're getting above plus 10% over the last few months. And then we look at communication services, also showing some leadership, getting above 15%, and industrials getting above 17%. So that's four of the six big sectors showing enough participation as far as strong uptrends are concerned to support the bull market thesis. Now, consumer discretionary would be one of the laggards over the past few days, as well as healthcare. So we can see that four of the big six sectors are participating. And then we look at the smaller sectors. The biggest of the smaller sectors is consumer staples, and it's hitting plenty of new highs. So it's doing all right. That's another positive. Utilities tailed off a little bit in April, but had a little spark of new highs. But, overall, this one's still bullish. Energy is the negative sector right now because it has yet to see high-low percent get above that plus 10% threshold. It's still, it moved below minus 10% in October and November and December, and we've yet to see new highs appear. So energy is the weakest as far as this indicator is concerned. And then you can see real estate and materials. Now, I also created a chart list with all of these high-low percent indicators. And, once you put them in a chart list, you can do a number of things with this chart list as far as viewing is concerned. So here they all are. You can see the symbols on the left. They all end in HLP. And then the preface, of course, is the sector symbol XLI, XLC, and it starts with a dollar sign because all of our indicators start with a dollar sign, the breadth indicators. And so what we do is I'm viewing in summary format. I could view 10 per page and see those individual charts. I'm going to go back to summary because I want to do a little bit of a sort here. And I'm just going to sort by the close. And so that puts the high-low percent with the highest high-low percent at the top, and that's industrials, communication services, technology, and finance, and consumer staples. So these are your 5 leading sectors right now, and these are the areas we will want to be looking at for individual stocks. And then you look at the bottom, okay, utilities is in a corrective mode, I would think, but healthcare is the only sector below its 200-day. Actually, energy is too. Energy and healthcare are below their 200 days and have low, high-low percent readings. So I would just be avoiding those sectors. And just a quick review of the candle glance charts for the 11 sectors. This is just a line chart. I created a custom candle glance chart. It's a custom style called candle glance, and I like it really simple. This is just a line chart with a 200-day moving average, and that way I don't get caught up into the day-to-day noise. For instance, if I go up and I change this style to 2 months, I'm going to get a lot more detail, but I'm going to get caught up maybe in the day-to-day noise with the long lower shadows and the long upper shadows and blah, blah, blah. And so what I'm going to do is just select my custom style because I want to filter out that noise. And when you look at this chart here, there you can see there's healthcare, the only sector below the 200-day. And it looks like the 200-day is rolling over. And there you can see energy got above its 200-day, but it's turning back down, and the 200-day is falling. So these two are by far the weakest sectors of the 11. And of course, the strongest is technology. And we're going to go into finance in a little bit more detail coming up here. Now, before we look at finance, I just want to show you a table that is showing the percentage of stocks in the sector and the index above their 200-day EMA. And this is a longer-term trend indicator. It's less sensitive than high-low percent. One day high-low percent can be above 10%. And then if you have a big down day in the market, high-low percent can go to 0. Whereas you can be above the 200-day and have one down day in the market and still be above your 200-day for most of the stocks. It's not going to switch as easy. Sometimes, you're right around the 200-day for a lot of stocks. But if we look at this right now, we can see the top sectors as we sort by the percentage of stocks above the 200-day EMA. You got utilities, technology, real estate, finance. 86% of stocks in the finance sector are above their 200-day EMA. That is a strong number. 82% of stocks in the consumer discretionary sector are above their 200-day EMA, and 77% of stocks in the industrial sector are above their 200-day. And then you have the S&P 500 for the benchmark. So everything above that benchmark is showing more strength internally, and everything below that benchmark is showing less strength internally. So now we're going to look at the finance sector because it has really perked up in April, and we got a break above the March high. What I'm going to do is I'm going to show 3 different versions. We got the equal weight finance ETF in the top window. We've got the small cap finance ETF in the middle window, and we've got XLF, the large cap finance ETF, in the lower window. And basically what we had here was a surge from late December to late February or so, and then kind of a consolidation pullback. And now we're getting another continuation move, it looks like, with the breakout above these highs. So equal weight broke out. Small cap finance is yet to break above that high, but it's got a channel breakout, which is bullish. And then large cap finance broke above those highs from February, March, and it's in bull mode. So I went through the stocks in the finance sector and I singled out 8 and I put them in a chart list. So this is a really good way to narrow your analysis. Say you want to focus on a specific sector. Well, you can run a scan of stocks in that sector and you can look at the candle glance charts of stocks in that sector. And then you can find the ones you really want to focus on. And so I picked 8. And if you can see I put these in a chart list. I'll choose the edit chart list function there, and there you can see there are the stocks in the chart list. And once you get it narrowed down, you can do further detailed analysis by using the view list as section. So I could go to candle glance, I could use 10 per page, I could even put them in an RRG, and that would show me the relative performance. Now this is weekly relative performance. I think Julius mostly uses this weekly. That's why it's a default. I'm going to go to a daily for a little bit more granularity to see how these stocks stack up against the S&P 500. And look at that. 7 of the 8 are in that leading quadrant. So they are leading over the last, this trail is 10 days. So you can see less than 10 days, but they are leading. And to get a kind of a sort of those, you can see that's the furthest from the axis there. And so we can see that JP Morgan is the clear leader, and then Goldman Sachs is a laggard within the group. But it's, even though it's in the weakening quadrant, it's on the right half of the RRG. So that's the good half to be in, so to speak. And let's look at some of these individual charts. So Bank of America is one I highlighted last week because it was consolidating there. You can see right above that high, we had this kind of pennant-like consolidation, and we can clearly see this breakout there with this big surge, and it looks like it's going to hit a new high. It's above its 200-day. 200-day looks like it is slightly turning up there, and you can see RSI became overbought, and overbought is a sign of strong buying pressure, and that is net bullish. It's looking like this was some sort of irrational exuberance or overshoot or something that declined in March and that reversal in April. I think Bank of America is one of the leaders. We'll look at Citigroup, similar situation. You kind of got this broadening formation here in February, March, and then instead of breaking down in late March, surged and into April and hitting a new high for 2019, and that 200-day starting to turn up. We'll look at Fifth Third Bank Corp. I had this one on my watch list in March and then got shaken out with this big decline here. So you can see that big decline there was not good for this analysis here if you had been holding a trade, because it looked like, we had this inverse head and shoulders pattern. We're breaking out and then the breakout failed, but now we're back above it. And you say, well, is this on trend or not? And I would say at best, it is getting on trend, all right? It's not on trend because if you look through 100 charts, you can find charts with stronger uptrends that go from the lower left to the upper right over the past year. And this one at a 52-week low in December. So it looks like it's starting to get on trend. And the problem with things that are getting on trend is they can still get off trend. And I would say the chance of them getting off trend is higher when they are in the early stages of turning around than when they are in a clear and present uptrend. So here's Goldman Sachs, and this is one of the more interesting charts, I think, because Goldman, you can't bet against Goldman. Goldman is Goldman. They survive through thick and thin. And what I'm looking at on this chart is you had a really long extended flag type pattern, and it looked like we were going to break out, and then it looked like we were going to break down, but we moved above that high there. And since we did that, I think we've got this little consolidation working here. So you got a big move up, a little consolidation. It looks like we're breaking out. And if you look at RSI, I think the cup is half full for RSI. You can see it was half empty here because you kept having these oversold readings. All right, you kept moving below 30 and you couldn't get above 70. And so now we've been able to get above 70. We touched 70, and I think the cup is half full for RSI now. So I think that's a positive for Goldman. But is it on trend? Well, no, it's in the midst of getting on trend. JP Morgan seems to always be the leader whenever the finance group moves. You know, it had that big shakeout down in March and then rallied back and a gap up, and it's already hit a new high intraday. Morgan Stanley turning it around after this consolidation and breaking out. So that is a bullish pattern. And then we look at PNC Financial, big move up. I mean, look at this 4-day decline that just broke to a new low broke below the February low and then rallied back. This is the kind of volatility we're dealing with right now. And finally, U.S. Bank Corp, big move down, but rallied back. And so it looks like finance is back for the moment, and that is a net positive for the market. So why are stocks in the finance sector rallying? Well, as technical analysts, you don't want to be too concerned with the why, because first and foremost, there are a zillion reasons out there for a stock to move up or to move down. For every buyer, there's a seller that has a different opinion. That's why he's selling. That's why one's buying. They think it's going to move in a different direction. And there are different reasons for buying and selling. Some people might be offsetting another position. Some people might be raising cash for another reason and have no outlook on the stock. So you just don't know the exact why. One thing that might be happening here is we saw the yield curve move higher in April. And look at that move up in the yield curve. That's the 10-year less the 2-year. And we can see above we've got 5 different Treasury yields. We've got the 30-year at the top around 2.96%, and then the 10-year around 2.54%. And then here's where it gets weird. We got the 3-month next, and then we've got the 5-year, and then we've got the 2-year. So we've got that partial inversion because the 3-month yield is above the 5 and the 2-year yield. And we can see that down below. Since March, the 3-month Treasury yield has been higher than the 5-year Treasury yield. So that tells you there's a bit of a yield curve inversion going on. Now, the point of this chart, though, is to show you what's happening with the yield curve in the 10 less the 2, which is, I think, the most widely followed one. And that seems to be helping out banks maybe with that move higher in the yield curve. Now, what I want to show you also is how I created this chart. First, I started with the US 10-year as the main symbol above, and then I used the price same scale as an overlay, and then entered the 30-year symbol, the 5-year symbol, 2-year, and 3-year. And that puts them all on one scale and makes it real easy to compare. And then I also clicked this box to show the y-axis labels, and that's the reason why you can see that Treasury yield value there on the right, and it's very easy to classify. And if they're close together, you can go over to the left, and there you can see the values as well. Now, since we're talking about Treasury yields, I'll also give an update to the Treasury bond ETFs. I've got IEF, the 7 to 10-year Treasury bond ETF in the top window, and the 10-year yield in the lower window. And of course, they move in opposite directions. You can see when the 7 to 10-year Treasury bond ETF moves up, you get a decline in the 10-year yield. And so that's what's been happening. You can see Treasury bonds have been moving higher, Treasury yields lower. Most recently, we had this surge and breakout. Then we had this throwback to the breakout zone. And now we're getting a bounce off of that zone there. So that's the first support zone to watch. And you can see the 10-year yield broke down, and then it got a bounce back towards that breakdown zone and is turning back lower. Now, see, if you're looking for a rationale for banks moving higher, you would say, well, man, falling rates should be negative for banks. Well, it should be, but that's the whole reason why I think you got to look at the actual price chart for the XLF and the banking stocks if you want to get an opinion on them. Don't get an opinion on banking stocks because of the yield curve or because of the direction of Treasury yields. Get the opinion straight from the source, which is the price chart for the underlying. So if we look at TLT, we can see that it got a breakout too. It broke above this resistance zone here. And you can also see that this maybe is a big inverse head and shoulders type pattern. So we got the breakout there. And then we got a classic throwback to the breakout zone. And now we're trying to bounce off of this zone. So broken resistance turns support, classic tenet of technical analysis. So this is a real make or break point. You can see TLT fell back yesterday, but it would have to close below 122 to negate this breakout and call for a reassessment. So now we're going to turn to metals, and the reason I'm going to show gold and silver is because I'm really working my way towards platinum, because platinum has the most bullish chart of the precious metals right now, and also look at copper. If we look at gold here, we can see that it's possibly in a corrective move right now. So basically you had this big surge. You had one breakout in October, another breakout in November, December, and quite a move, 111 to 127. And now we're getting this pullback. And we formed a falling wedge, which is typical for a correction within a bigger uptrend. And you can see we're in that, we got to the 50% retracement. So whenever we get into that 38 to 61.8% retracement zone, I kind of go on alert, all right, for a potential upturn and a bounce. And we definitely got to it with that move to the 119, 120 area last week. Now, you never know, is it going to happen at the 38%, at the 50%, at the 61.8%? You just never know, all right? But, if gold is going to be strong, you would expect a 50% pullback on average, because the deeper the pullback, the more selling pressure. So this is like 2 steps up and 1 step back. And gold is starting to turn up. And if we get a breakout there, then that is going to be bullish for bullion. And there you can see RSI move back into its bear range there, and it needs to break above 60 for momentum to turn bullish again. Now, as far as I'm concerned, there's really no sense to even analyze silver, because silver does not have a mind of its own. It's highly correlated with gold. There you can see 0.82 is the correlation coefficient. I think gold is the main driver. Sure, it was briefly negative there in October, but for the most part, gold and silver move in the same direction. Silver is just kind of like gold on steroids. So, if you're turning bullish on gold, then silver, you'd be bullish on silver as well, because you'd expect it to move, and it'll probably move higher at a higher rate. If gold moves up, it'll move up more than gold. Of course, if gold moves down, silver is going to move down more. So before looking at platinum, I just want to show you the continuous contract, which is dollar plat, and you can use that for longer term charts here. But what we can see is that, you've got some support coming in that 780, 770 area twice. We got a breakout there above the 200-day with a big surge in February, a volatile throwback, but we got another breakout and above a big resistance zone from that October, February high. And since then, we've been consolidating. So let's turn to the platinum ETF. So here's the platinum ETF, and to be perfectly honest, I'm just showing this as a matter of interest because it's not a very actively traded ETF. It's not really for me, but I see some interesting price action relative to the other metals and relative to other symbols out there, in that you can see PPLT had the big surge, the consolidation. Looks like a consolidation after a breakout, and I would watch for a breakout and a continuation higher. And just so you can see volume, I've got another chart here. I can show you the average volume. You can see it averages 78,000 shares a day over 250 days. And yesterday's volume was 50,000. So just be forewarned about that. And finally, we have copper. And I'm going to start with the continuous futures contract for copper. But we can see, what looks like some sort of a basing period. And then we got a break above the July, September, October, November, December highs there with that move above 290 roughly. And then we're consolidating above the breakout zone. So this makes copper interesting. And you can see RSI is holding that 40 to 50 zone. So this is kind of a make or break area for copper. Now, I'm not going to extrapolate and say China's strong, so copper is going to be strong. As I said before, I think there are just way too many factors out there influencing the price that we can't just pick one factor and say that's the key factor, because to tell you the truth, we really don't know. So let's just stick to the chart and let the chart tell us what's happening. So here's the copper ETF, CPER, the U.S. Copper Fund, and we can see a similar pattern emerging. There's the break above that high and above the 200-day, and then consolidating with some choppy action, but it looks like a consolidation above the breakout zone, which is a bullish continuation pattern. You know, you could draw trend lines. I'd probably just opt to draw through this one, and maybe we have some sort of a triangle forming, and a breakout there would be bullish for copper. And if you're wondering about the liquidity for this ETF, I'll put on this template with volume. It is more liquid than the platinum ETF, 126,000. Sorry, less liquid. It's 12,000 shares a day. So yeah, I don't see anybody trading this with any massive size at all. And yesterday's volume was 26,000. All right, we're going to look at some stocks, starting with some cybersecurity stocks. Here's Palo Alto Networks, and this is clearly one of the leaders out there. First, you can see that it had the breakout above resistance, the break above the 200-day, a new 52-week high there in February. And now it's kind of consolidating above this August-September high zone there with a triangle. That's a triangle within an uptrend. Consolidation within an uptrend is typically bullish, and a breakout in the making is bullish as well. Next up, we have Proofpoint. It's a little bit messier of a chart, but we can see a similar situation with some breakouts, a sloppier consolidation, but that looks kind of flaggish, and it looks like we're getting a breakout, and that's a new 52-week high in one of the key stocks in one of the key industry groups right now. SecureWorks is also a cybersecurity stock. It's a spinoff from Dell Technologies, and it's a volatile one. You can see it was up like 76% from December to early February, and then had a long correction. And I'm calling it a correction because it was relatively, how should we say, tame. It wasn't like a sharp decline. And so we corrected, worked off the excesses, starting to firm in that 17 to 20 area. Yep, it's volatile. And if you get a breakout at 20, that is going to be a bullish development. Next up, we have the MJ ETF, which of course is Mary Jane, or the cannabis ETF. And you can see it's been consolidating after this big run up. And we can't draw a picture perfect triangle, but it's a big advance. It's some sort of consolidation. There's the decline in March, April, and it looks like we're turning up within that consolidation. So that's the early signal there, the upturn within the consolidation. You can see the PPO turning up as well. So the next thing would be a breakout above resistance. And eBay, we can see eBay with a breakout in the making. We had the big gap and breakout above resistance, move above the 200-day, and a nice little wedge type consolidation with a gap breakout there that looks bullish. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.